An index fund generally tends to be a very inexpensive way to invest in the market. What an index fund is designed to do is to follow that specific index, which I realize kind of is using the same vocabulary over again, but to give you a specific example, so the SPX, which is the ticker for the S&P 500, or like people also call it the spider, it's designed to specifically replicate what the S&P did today. So for example, if you turn on CNBC and they said the S&P went up, let's just say 1% for the sake of argument, your spider or your SPX should have also gone up 1%. So what people tend to do, like I think Vanguard has made huge inroads in this of basically recreating the index. And so let's say you're saying, I really have a strong feeling right now on technology, for whatever reason it is, but you have no specific view on a specific stock within the technology sector. A lot of people will just go out and buy the technology, like the index that represents technology. Really inexpensive way to get access to the market, and you basically are just replicating what that entire sector is doing. And there's really an index for pretty much every possible space. They've become extremely popular and are definitely changing the way people look at investing money.
There's a big controversy. I don't know if you call it
Controversy.
There's a lot of discussion around which is better, using index funds or what they call actively managed funds, or some people call them hedge funds for the most aggressive type of actively managed funds. And the big difference is the index funds are very low cost, whereas these actively managed accounts are higher cost. And it's been alleged in some recent books that have come out that actively managed funds don't really do a great job of beating the market any better than index funds do.
So that's yeah.
I'd like to hear your comments.
Sure. So there's a huge push right now for passive versus active investing. Passive is just buying the index. So there's really, like it literally is, honestly, if you would think about what's actually happening on the trading floor, it's like a computer algorithm that's like basically determining what that sector is going to close at the end of the day, and it basically replicates that. You can imagine, like, it's basically a computer program. They're charging like 15 bips, 10 bips, sometimes less than that. Very, very inexpensive investing. Whereas mutual funds, which is what we would call more of like an active management, where there's literally a person that is specifically going through all the financials, talking to companies, doing all this legwork to determine what they actually think of a specific name. That's what we would call more active management, and fees can be anywhere from like 1% to 3%. I mean, they can get really quite high. What I personally believe in regards to the active and passive space, when we have areas what we would call efficient markets. So efficient markets are areas where there is a lot of communication, a lot of news. Information is what we would call like literally instantaneous. So if I got back in my car right now and something happened at Goldman Sachs, like it would be across the entire market within seconds. Whereas there are more of like the small cap space, so small cap meaning more of the smaller businesses by capitalization, their markets are not as efficient. So for example, right now what's been going on in the market this year, the small cap space has really seen a huge push. And I would heavily argue that yes, there is room for the active manager to make money. Where I specialized when I was at Deutsche Bank in the investment bank, I would advise high net worth clients, some mutual funds and other RIAs, about the alternative space, so specifically commodities. There's so much room in the commodity space because there's, and that's a whole nother lecture as to why there is so much opportunity for a manager to make a difference. My brother-in-law is a portfolio manager for an emerging market company. He's literally in Asia on a regular basis, talking to companies. And again, the emerging markets, it's a very illiquid space. The information's not spread as quickly. The financial statements aren't always accurate. They're not always truthful. There's a lot of room for him to, make a mark on the market. So yeah, I would heavily argue that I think I would be doing passive in the large cap space, and active more in areas that are not as like quote efficient.
your company 401k probably won't offer
Very little alternatives.
the active alternatives in the small cap space. The cap, small cap, medium cap, high, they take the number of shares that are outstanding and multiply it by its market price, and they get a number. And if it's below $1 billion, they typically call that small cap. If it's above 100 billion, they typically call it large cap. And if it's anywhere in between, it's kind of mid cap.